Good morning, everyone. So we're back here in Investagrams, and today we're gonna have a discussion on what time frames should you use in your trading settings, whether that be in your indicators, whether that be in looking at price action, or whether that be you're implementing a new system. The time frame is always a deciding factor on how you would execute and how you would perform as a trader. So here are some points that we should think about before choosing our time frames. So now, when you start on your trading journey, before you use a system, you should analyze the pros and cons of each setting. So what we try to teach in Investagrams, you can see we don't teach a single system because there's no perfect system. Whether you're trend following, buying supports, swing trading, or doing bounce plays, all of these systems have pros and cons. And that the same applies with using time frames. So if you're using a 50-day medium-term time frame, if you're a momentum trader using a 10-day time frame, then all of these would have pros and cons. So this is what we're gonna show to you in this video. And now, one important thing is when we study from other people, when we study from books, we study from other sources, there's going to be default time frames that is specified on their systems, right? But as a trader or as an investor, you can actually modify this depending on your life situation. Okay, so one example is if you're busy on work, then instead of using a quick 5-day or 10-day moving average, why not shift that to a 30-day or 50-day so that your signals are more clear and gives you more time allowance. All right. And now later on, I'm going to show you my realization on my own experiences as well. Okay, so let's begin. These are the main points that we're going to tackle today, and then I'm going to show you how the time frames would actually impact your execution on your charting or on your indicators. Okay, so before we go into the different time frames, I'm just gonna give you a quick idea of what each time setting means for me, okay? So there are those who use 10 days, 10 days or below, okay? 10 days, super short term. Then let's just replicate this. All right. So for this video, we're going to use moving averages as our sample. But to understand the time frames, the meaning of each time frame is you have to put into context. So if you're using a 10-day or below moving average, that's super short term, meaning you're just averaging the last 5 days or last 1 to 2 weeks of price action. Okay? And it also depends if you're using intraday charts, so that's going to make the averaging more quicker. Then 20-day is roughly around 1 month. So if you want to know the dynamic trend or the message of the price for the last 20 days, last 1 month, then 20-day is a good starting point. And then 50-day is like 2.5 months in terms of trading days. So just so you know, so I find the 50-day, the medium term, is like the median point. It's the most reliable for me, depending on your style. But if you have the 50-day as part of your indicator settings, your moving averages, you could use it whether for swing trading, for day trading. So I find it a good balance between short-term opportunities and long-term opportunities. And then you have the longer term, 100-day and 200-day settings, right? So these longer term averages give you the more significant signals, the major turning points, whether you see major reversals or major trends happening. So that's where the 100-day and 200-day comes in. Okay, so now seeing all of this, it totally depends on your lifestyle, on your so just to illustrate, I'm going to show you an example. Okay, so we're at PSEI example. Let's choose MEG. So using a 20-50 combo on the crossovers, we see here that MEG is clearly on a downtrend, right? So the blue line crossed below purple line. And then up to now, we still haven't had a positive crossover. There's no bullish signal yet. And you can see you could use these trend ranges, these moving average, the range between the moving averages, as a way to find resistances as well. So up to now, Meg still has a hard time of getting above the EMA 50. Okay, so if you were short selling, that can be a short selling approach as well. But of course, you can't do that in the Philippines. So we see here that, whoa, from August last year up to today, April, so more than 5-6 months, we're still on a medium-term downtrend based on this crossover signal, right? Now let's try to shift the game. So example, I want to look for more quick opportunities. So this is the difference. So we see lots of traders resorting to shorter time framed settings, all right? While this may be good, this would be good for traders that can really monitor the market, can really execute on the dot. But if you have a day-to-day job, this would be hard to fit in your trading lifestyle. So what do I mean by this? Now let's see the signals, the difference in the signals. So it's the same in the crossover. When the market topped, you still had a warning sign, but then in between that downtrend, you're given crossover signals on the mini bounces. So example, we've got the crossover here, then that means if this is your buying and selling framework, then you get a buy opportunity here, but then where's the sell opportunity? Here. It crossed below here. So that's a 1%. That's around 1% reward if you're basing on crossovers, right? So that's one thing. So you get these signals that are kind of weak. Totally depends on the overall trend, but then the shorter your time frame is, it's good that we're able to get these micro signals if we're an intraday trader or a shorter time or a momentum trader. But then for the regular person, you're gonna have a hard time following this signal. Now sometimes my experience is we follow a short-term signal on the entry, but then on the exit, because we're not able to monitor the intensity, the same pace of that signal, sometimes we just resort to holding the stock. So your entries are not consistent with your exit framework. Okay, so that's one downside. And now you could also use a simple price crossover rather than MA crossovers. So let's show what happens here. So example, if simple MA10 is your benchmark for saying that, okay, the stock is already finding confirmation, short-term momentum. So example, you buy here at, I'm just gonna zoom in, 458. So you see here, you get a mini price breakout and a mini moving average price crossover, right? And then the challenge is, if you're monitoring the markets, sometimes you'd get whipsawed if you're too tight with your settings. So in this candle, we see a wick going down, right? Here, 470, 480 goes down, it dips a bit to 480, coming from 480 plus. So if you're monitoring using a very tight moving average, this tightness can also lead to whipsaws. So you have to know in your rules, do I follow it tightly? When there's an intraday snap, do I get out instantly? Or do I have a certain allowance, or do I wait for EOD? So if using this system tightly, if our rule is buy when the price is above EMA 10 and then sell when the price is below that, you're going to see here that there's a close on the next candle here. It closed below the red, our purple line. Okay, but one thing that you can do, of course, is, for me, it's always about balancing indicators with price action. Okay, so for example, we got a close here. But then on the range, we still haven't broken down yet. So in this area, 5 to 10 day range is still holding up. So instead of just using the indicator as your basis for entries and exit, you could also use price action as the final confirmation. So by using that, you're able to give yourself more confirmation here. So instead of just being whipsawed just based on the closing of the EMAs, look at this. So by this point, you're already closed out, or as early as this, right? But if you use price action, price patterns, price formation, then you're going to have an exit here. So it will give you, let's see the opportunities, it would give you around 3%. Not bad, yeah. But then the challenge is in the Philippines, one buying and selling round would cost you around 1.19%. Remember that. So if our gain here is, you see here, 3.95, 4%, you've taken away almost 1/4 of your profit potential. Meaning, if this is a business trade, if this trade is like a business, your cost is already 25%. So take note of that. That's one personal preference for me, why I focused on bigger picture moves rather than too short of a time frame in my trades. All right, that's the pros and cons. So, and again here we get another signal, downtrend signal, and this would actually be profitable if you're using it for shorting. 15.97%. All right, and then so the problem is we don't have shorting in the Philippines, but you can apply this in global assets. Then here, say you get a positive crossover here. But the problem is, since we're in a major downtrend, you barely make significant percentage out of the trade. You're just stopped out after a while. And again, you could shift to price-based crossovers. So we see a EMA 10 price cross here. Then you see a price break on the 5 to 10 day range here. Then we see a close here at this point. So if you're looking at that EMA snap, then you get another 3% upside. So it's good for momentum traders, for scalpers, for really quick swing traders. You can use this. But if the stock isn't trending, or if the stock is in a major downtrend, I won't suggest using a super short time frame for your trades. You're gonna see here that you're gonna get whipsawed a lot, and you're gonna get small rewards for your. So let's take a look at. Let's compare it on uptrending scenarios and downtrending scenarios. Okay. So example here, if we're using 50-20 on our settings, and you get a positive cross here, then a negative cross here. So your returns at this point would be around 6%, not bad, right? So, but this situation is tricky. After you get a sell signal, you instantly get another buy signal, also coming in with the re-breakout. So example, you buy back here, and then your selling would be at this point here on the bearish cross. So you can see the differences. Each crossover swing gives us 6 to 11%. Now compare it to a tighter crossover system. Just gonna zoom in the chart here. So example, we're using 10-20 day again. So we get a crossover signal around this point, and then we get a negative crossover at this point. So this would equate us to 5%. Wait. So if you get the cross here, you're gonna probably sell here, right? At the red candle. So you get a 3% move, but then there's another buy signal, so you put it, let's plot it again. Where did that signal end? Around this point. See here, okay, at this candle. So here we get 3.7%. Then this on this candle, depending on whether you sold EOD or let's say you sell half of the range between the intraday and the EOD. So let's give it 5%. Okay, and then in this phase we don't get any signals, but then there's a crossover again at this point. There's a crossover again at this point, and then up to now it didn't have a negative crossover, so goods. So that's around a 17% gain. So what do we observe here? In this bull cycle, in this trending phase of alley from November to August, we get around 3 signals from the 10-20 day cross, right? Then some signals give us 3.70%, the other signal gave us 5.75, and this one, when the market started to really trend, it gave us 17%. Now let's compare if we resort to a more medium-term approach. So now how would our signals go? So we get a positive crossover here, and then the selling signal would come around this point. So example we bought at this point. Wait, hang on. Example, you bought at this point, and then the sell signal comes in here. So that's 6% move. So instead of having 2 signals, you only get 1 signal and you just follow the trend. And then at this point, the re-breakout, you also have a signal, and then your selling is a bit more late here. So the crossover would be around this day. So that's a 10% move if we just base it on a crossover signal. Okay, so in this case, we only get 2 signals, a 6% move and an 11% move, right? Now we see the different pros and cons. On the shorter term side of things, we get more signals, but not necessarily all signals are significant. So first one was 3%, the other one was 5%. And then take note of your commission costs and the time that you have to monitor. Can you exit instantly as fast as this signal, right? And then for the medium term, you don't get too much trades, but the percentages are more significant. But at the same time, since you're giving too much allowance on the time frames for the stock to move, to give you that 50-20 crossover, you're also giving up some profits as well. If you solely based this, you're trading on this indicator. Okay. So what happens is, instead of taking the 17% profit on this big move, you've given away almost 1/3 of the profits. So that's one downside. The longer the moving average system that you use, the longer the delay as well on having these crossover signals or these confirmation signals. Okay, so looking at comparing the two systems, the first one, shorter time frame, gives you quicker reactions but smaller profits, and then more errors. There's potential for more errors because if you have more signals, then as a human being, you're not going to perfect every signal, right? There's a human tendency that we're going to have mistrades, misexecutions, wrong executions, right? So that's one downside on having too quick signals or too many signals. But then on the other hand, you're able to react fast to the price. But then on a more medium-term approach, you're more relaxed, you're more laid back, but then you miss on some quick price reactions, but then you're able to capture the bulk of the move, medium term of the move. So I hope that this comparison on the time frame helps. And the thing to note of here is to really experiment for yourself. We cannot dictate the indicator settings that you use. We cannot dictate the perfect system that would fit for you. What's important is that you really experiment. How would these technical indicators and systems work for your actual life, for your actual execution, for your actual style as a trader, for your actual risk profile? So when you put all of these together, then that's going to help you. That's going to help you with your decision making on how to use different indicators or time frame setups.